Here's some entries to record and manage deferred tax assets and deferred tax liabilities. For this example, we have an expense that must be deducted for tax purposes in 2017. But for book purposes, we're going to record that expense slowly over time in 2018, 19, and 20. What that's going to do is our book income is going to be higher than our taxable income. But we know it's going to catch up. So the tax on the higher book income, we know we're going to have to pay later. And the fact that we know we're going to pay something later is the liability that we have to record. So what we need to do in theory is calculate out our tax for book purposes and for tax purposes. We need to keep them in mind, keep our adjusting years in mind. So for the first year, for example, we've got $400,000 in income before the issue that we're dealing with, but for book, we don't get to deduct it. For taxes, we do get to deduct it, so our taxable income is $210,000. That's higher than the $400,000. When we consider that there's a 30% tax break, we're talking about the $400,000 is going to have taxes of $120,000, and the $190,000 or the $210,000 in income is going to have tax of $63,000. So this difference here is something we have to make sure we account for. We know that this extra $57,000 that we're not paying in taxes in 2017 is going to be paid in the future. So we know we're going to pay something. We have a deferred liability and we need to record that. So in a second, on the next slide, I'm going to show you how we set up the table to put all that information in accurately. What I find makes the most sense is if we calculate out a separate section for book and tax. Sometimes it might look redundant, but I think it's also easier if you put every step in for each item. That way you're not missing anything and you don't have to worry about forgetting which direction things go. So for here, we're told that we've got $400,000 income before taxes. So this, they've already taken their expenses out and everything's in there except this reversible issue. So that's the amount of income we have for book and for tax. We know that this $190,000 is deductible for tax purposes, but not for book, because it's going to become deductible in later years for book. So then we calculate out what happens. We know there's a 30% tax rate. So book revenue of $400,000 minus no expenses is $400,000 times 30%. We've got a tax of $120,000. On the tax side, we've got $400,000 less the deduction of $190 gives taxable income of $210. That gives taxes payable of $63,000 and a difference of $57,000. What we're going to do now is pay attention to the terminology as well. If you notice on the book side, it's called tax expense because the expense recognition principle says we've got to record the expenses when we've earned those revenues. So we're going to record expenses of $120,000. On the tax side, we're going to credit taxes payable because that's the amount that we owe the government agency. If we debit the expense and credit the payable, in the moment, in the year we make the reversible issue, we're going to be left with something either needing a debit or credit for the entry to balance. We know that this $120,000 is $57,000 more than we're paying in taxes, and we know we're going to owe that $57,000 in the future. The fact that we're going to owe it makes it a liability. So it makes sense to debit the expense. I like crediting the payable, and then putting the middle is going to be your asset or liability. And in this case, it's going to show itself to be the liability for $57,000, and that's going to be able to back into our theory. Going forward, we're going to do the same thing. We're going to record the income, and we don't know that we're really going to have $400,000 in income, but we do know that this is the only reversible issue. So I'd actually have the exact same journal entries if I made it for $500,000 or $300,000, whatever, as long as I'm consistent on my book and my taxes. The only thing that I'm putting in different is I'm going to take the deduction for each of these years for book purposes. And then I'm going to get a book income before taxes for 2018 is $345,000. At 30%, it's $103,500. On the tax side, I'm left with the same plain $120,000. So what's different is going to be the tax on this deduction. So this is the entry that I was just mentioning. We're going to take the $120,000 debit tax expense. We're going to take the taxes payable and credit that for $63,000. The difference is going to be the $57,000, and then we're going to think about exactly what that means. It means in the future we're going to owe taxes because our taxable income will be higher than our book income in the future. We know we owe it. It's a deferred tax liability. What if we consider the exact same situation, but we reverse it? And for book, we've got the deduction in the first year. We're not allowed to take it for tax purposes. We're allowed to take that deduction in later years for tax purposes. The exact opposite comes in. Our book income is going to be lower than our taxable income. But we know that we're going to get to take those deductions and we're going to get that money back. It may not be back in cash, but it'll be back in lower taxes. So we have that coming to us. It's going to be a deferred tax asset. We're going to do it pretty much the same way. We're going to set this up the same way. We're going to take our expense and our revenue. We're going to take the revenue the same for book and for tax. We're going to take the deduction this time. The first year, we're going to take that deduction for book purposes. We're not going to take it for tax purposes. And then we're going to take those deductions in later years for tax purposes. So in year one, book income before tax is $210,000. Same 30% tax rate. So tax expense is going to be $63,000. And then on the book, on the tax side, on the tax return, our income's higher at $400,000. So taxes payable is $120,000. So we're actually taking an expense now, but paying more in taxes. And we kind of know that's not right. We're going to get that money back, so we've got the deferred tax asset. We move things forward in the future. Same thing, we do not have the deduction for book purposes, but we do have it for tax purposes. And we're decreasing the deferred tax asset until it reaches zero. We think of our journal entry the same way. We always debit tax expense and credit taxes payable. So the difference is going to need a balance. Is it going to be a needed debit, which would be a deferred tax asset, or a needed credit? In this case, we know that we're debiting for $63,000 and crediting for $120,000, so we know we need that debit. So you want to look back and make sure it matches your theory. Well, the fact that you've got this refund or less in taxes later coming to you makes it a tax asset. And our journal entry is the same thing that we did the last time. We're going to debit the tax expense, we're going to credit the taxes payable, and the difference is going to come right up to become the $57,000 deferred tax asset. In later years, we're going to kind of do the same thing. We know what's happened because we've already recorded the flip side and the deferred tax liability. But in later years, we know that our tax expense is going to be higher than our taxes payable. So we're going to debit the tax expense, credit the taxes payable, and we will be crediting the deferred tax asset. That's how we're going to reduce it to zero. So what happens if you don't think you're going to get to recognize that deferred tax asset down to where you reduce the balance till zero? Well, here's an example for that. If we have a deferred tax asset and the balance is $200,000, this year we've got a temporary difference of $425,000. That difference is going to actually increase by $175,000 during this year we're talking about. For example, we just stuck with $950,000. Doesn't really matter what our taxable income is, and a 40% tax rate, And then when we're done, we figure out that we're probably not going to get to recognize 40,000 of our deferred tax asset. So if we're starting with 2018, we're just putting some 2017 numbers in as we've been told. We've been told there's a 425,000 temporary difference, and we know there's a 40% tax rate. In 2018, we're told that there's a temporary difference increase of 175,000 and taxable income's 950,000. So book income must be 775,000 just by by common sense. You've got your book income plus the increase in the tax difference must get you to your taxable income. Multiply that by 40%, you end up with income tax of 380. And then in the next year, we're just totaling the differences of 600,000. That's just simply the 425 and the 175,000. So we would need something. We've got a benefit of 240,000 for income tax to get rid of these differences. But we know that 40,000 of it's not going to be recognized. But in dealing with the 2018 entry, we're going to follow along with what we've said, that you're going to debit your tax expense, credit your taxes payable, and you've got your amount in the difference. Our journal entry is exactly what we would expect. We're going to debit our tax expense, and we know our book income times 40% is going to be 310,000. That would be our tax expense. We know we credit our income tax payable for 380,000. And while we didn't create the deferred tax asset this year, we do know that it increased. If it would have decreased, we would have credited it, but it increased. Just like generating a new one, we're going to have a debit there to cover that amount. So that would be your entry right here. If you think about what goes on the next year, you debit income tax expense, and you hope that you're going to be decreasing in the offsetting years for your temporary difference. So when you're decreasing your deferred tax asset, you credit it, and then you would credit income tax payable. So logically, we're going to credit deferred tax asset in order to get rid of the deferred tax asset or reduce it. We would also offset that by debiting income tax expense. So we need to deal with the 40,000 of non-recognition of the deferred tax asset. And we're going to kind of do the same thing. We're just not going to have income tax payable because we're not going to get the benefit of that on the tax return. And this is the entry. We're simply going to debit the income tax expense and credit the deferred tax asset for 40,000 because that was the amount we didn't expect to recognize. So we have rewrited everything, if I can say it that way. We have adjusted for our increase in our deferred tax asset, but we've also adjusted that we're not going to receive some of the benefits. And that's how you take care of a deferred tax asset with non-recognition. You would do the exact same thing, except you would be debiting the deferred tax liability if those were the circumstances to which you were making the recording. And those are entries to record a deferred tax asset, a deferred tax liability, and how you deal with writing it off when you have non-recognition. If you were simply going to write it off in later years, we also covered that as well. And so you should be all set with your deferred tax issues.